if you find yourself scratching your head at this action, a sharp sell-off after the Federal Reserve told us they'd keep interest rates low yesterday, Dow ultimately dipping 153 points. S&P lost 1.48%, but the Nasdaq dropped more than 3%. Allow me to explain. Low interest rates are supposed to be good for stocks, but they're not good for all stocks. The real winners are the industrials because they make more money when the economy is roaring. And the banks, because low short-term rates coupled with higher long-term rates are nirvana for the profits for the financial industry. Meanwhile, the growth stocks, well, let me just say they are getting annihilated, especially tech, because they're all about the future earnings stream many years down the road. And those earnings, well, let's just say they are worth a lot less in a world with lower rates and higher inflation. And that is the world that many of the big-time investors now think we've fallen into. So, as a pro who has seen this happen, frankly, a gazillion times, let me explain how all this Fed, inflation, bond, rates deal works when it comes to your portfolio. At any given time, you got tons of money managers chasing the hottest of the stocks, right? That's what we all do, right? We chase the hottest of the hot. It's instinctive. Specifically, they want companies that will be able to deliver the biggest year-over-year earnings beats without as much risk of an earnings screw-up. So for years, that meant buying FANG, Facebook, Amazon, Apple, Netflix, and Google. But when the economy heats up, these consistent, great, high-speed growers cannot compete with the boom and bust names like the old-school industrials that generate gigantic upside surprises. You know what? They never can. It's like clockwork that the FANGs get sold. You just might not be paying attention to it because ultimately they come back. But this is like the 20th time I saw other people in the network say they're dead, they're dead, they're dead. Okay, well, they're dead for now. They're like, dogs that roll over and play dead. Normally, when business speeds up like this, you'd expect the Federal Reserve to tap the brakes by raising interest rates. But yesterday, Fed Chief Jay Powell vowed not to do that, at least not anytime soon. So the Fed's basically saying, party on, industrials, which causes the hedge funds to buy them hand over fist. But problem is, if they want to buy the banks or the smokestack stocks, well, they don't have a lot of money just sitting there. They need to sell something. So what are they dumping? The high-growth tech stocks that they always dump. And that's called the hedge fund playbook. But even for a sector rotation, this one does feel a little severe. Why? Supply and demand. Our country has created trillions of dollars worth of tech stocks. They're being printed like Confederate dollars, and a lot of the SPACs are Confederate dollars. Well, they seem like it. It makes sense, because what works in a stagnant economy is to own tech, and we've had decades of stagnation after the financial crisis. Meanwhile, there's been virtually no new issuance for the banks or the industrial stocks. In fact, those companies have been aggressively buying back their own shares for ages or merging and wiping out whole companies that might have been bought at this very moment. So when demand spikes, there's just not enough actual supply of this kind of stock to go around. So the stock goes higher until sellers come out. And even here, even after these big rallies, there's still not a lot of sellers in the industrials. Let me give you how much it matters. I used to be a trader. I mean, based on my experience, I think you could actually push a Dow stock like Caterpillar. I bet you could jump that stock $3 or $4 if you bought 1 million shares, $231 million. That's nothing for these big money managers. That's right, $231 million. It would take multiple billions of dollars of buying power to generate a single point move up right now in any of the larger tech stocks that you might own. Most of those tech stocks, by the way, are net issuers of stock, meaning they're adding new supply, even at a time when demand's drying up.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.